Hello. Thanks very much for coming along today to this event, and thanks very much to Finance Magnates for inviting me to speak here today. So my name's Tim. I'm from KCM Trade. So we've got the car over here, which is a Formula Drift Japan car, which we've brought to the event. So feel free to come by later on and take a look. And so basically, I'm the Chief Market Analyst for KCM Trade. And as we often like to say, there's never a dull moment in financial markets, and that's certainly been the case so far in 2024, and particularly for gold. So three of the things I'll be talking about today are gold, the US dollar, and interest rates. So they're three things very dear to my heart in terms of how they're intertwined and how they move markets. So I think that's an interesting relationship to look at. So just to give a little bit of context on that, so when I wake up each morning, my job is to basically catch up on what's happened in the overnight markets. So I'll have around 10 data points that I'll be using to catch up on what happened in the US overnight and to see what will happen during our Asian market. And so of those 10 key data points, 3 of those will be gold, treasury yields, so an indication of interest rates, and what the US dollar did. And anecdotally, I can say that probably 7 or 8 times out of 10, if I know what gold did, I'll know what the US dollar did, and vice versa. So I think when it comes to trading, we're all looking for ways to make it a little bit easier by identifying patterns or relationships, which can, we can basically use to join the dots and see these relationships between assets. So gold, the USD, that's certainly one I've identified as being, quite key to working out what's going on in the markets. So let's take a look now at a few of these slides. So as we can see here, when we talk about gold and the US dollar, there's a correlation. I've known it anecdotally, and we'll look at some empirical evidence in a few moments' time. But generally, it's what's called a negative correlation. So as gold goes up, the US dollar would go down and vice versa, with some exceptions, which we'll get to in a little while. We'll also look at what factors influence gold and the USD at the moment, and the role of interest rates. So markets are very sensitive to the interest rate picture. If we look at what's driving US markets, Asian markets, very interest rate sensitive to what's happening with the Fed, and that plays out in terms of what happens to some of these assets as well. So let's have a look at gold, what it's done so far this year. So as I said, a record-breaking year for the gold price. So it's moved above the $2,500 an ounce level, which is all-time highs. So we'll look at some of the reasons, for that. One of them has been central bank demand. So there's been a big push in recent years by the likes of the Chinese central bank, Russian central bank, Turkey, Poland, to increase the gold reserves to reduce reliance on the US dollar for geopolitical reasons, let's say. So we know what happened after sort of the Russia-Ukraine war. Some central banks, Russia, had assets frozen, whereas if you're holding your reserves in gold, and they're in your bank vault, then it's less susceptible to foreign sanctions. So that's one of the reasons. And just on that central bank demand, and we'll look at a chart in a moment, that's been increasing. So in Q2 this year, Poland and India were the 2 main central banks who are buying gold, and that's been basically underpinning that upward movement in gold so far this year. Turkey's also been doing it quite heavily as well. In terms of India, it's not only just central bank demand there. So there's been a rise in what's called gold-backed loans. So where you're putting up gold as collateral for a secured loan, that's been on the increase in 2024. So as the gold price has gone up, people are getting more bang for their buck when they put up gold as collateral to take out a loan. That's been sort of leveling the playing field in India in terms of people getting access to loans in rural areas versus urban areas. So that's a key note as well to look at. Safe haven buying demand. So I touched on the Russia-Ukraine war, and also we've got a pretty hot situation at the moment in the Middle East, of course, with what's happening, Israel, Hezbollah, rockets firing, etc. A lot of supply concerns there. Gold is generally a safe haven asset in that regard as well. So when you see a lot of risk aversion in markets, the natural tendency is for people to move towards adding gold to their portfolios. So right now we've got 2 essentially hot wars at the moment around the world. So Russia, Ukraine, Hezbollah, Iran, and Israel. So that's keeping gold in favour as well with a lot of traders this year. The third point I've got here is some positioning ahead of a lower interest rate environment. So as we know, the Federal Reserve, they're probably going to start cutting rates, it looks like, next month, embarking on a rate cutting cycle. So generally, as a golden rule, when interest rates are high, gold doesn't do so well because gold's a zero yielding asset. So you're getting basically a physical asset, but one that doesn't give you a certain yield, as for example, treasury yields do. So we've seen over the past couple of years, US rates have been at 5.5%, and treasury bonds in the US have been paying between 4 and 4.5, 5% in terms of return. So people have had the option to buy bonds, treasury bonds, and get a pretty good rate of return, risk-free return, and that's sapped some demand from gold. But as the US starts to cut rates, that helps gold because there's less opportunity cost. If you're putting funds into gold, that means you've got less funds to put into assets that are returning, be it 5% for treasury bonds or maybe 10%, 15% if we look at equity market returns so far this year. So, if we have a look at global gold demand, so this is from the World Gold Council, this chart. And I think the one we want to look at there is quite appropriately, the gold line there, which has been on an uptrend basically from 2020 to 2024. So what has been making up that gold demand? So we can see a mixture there. There's demand for people for jewellery. So people, producing jewellery in the likes of, say, India or the Middle East, they've been buying gold for that purpose. We can also see there reference to technology. So we know that there's been a big push in the AI sector. So the AI boom, a lot of big companies are investing in infrastructure for the AI industry. They're expanding and they're requiring gold and gold elements to build the infrastructure for that. And of course, we can see there the central bank demand that I touched on there before, as well as the light blue one there, so OTC investment and stock flows. So you can consider that your general retail buying of gold and gold ETFs, which has been pushing the price higher. So as I think the thing we can take away from that chart is that uptrend that's been happening pretty much from 2020 to 2024, driven very much by that central bank buying that we see there. So now I wanted to talk a little bit about why gold and the USD do have this negative correlation. So they can be seen as competing assets very much. So, if a lot of investors look at it in terms of, okay, if I want a safe haven asset, I might buy gold or the USD. They both take on that safe haven characteristic. So because they are competing assets, that's why generally if one goes up, the other goes down. Not always, but that tends to be the case, and we'll have a look at a chart for that in a moment. I've touched on there the opportunity cost of holding gold. So the US dollar, as I said, we've come out of a period of high US interest rates. So if you've got US dollars and you're investing in the US, you've been getting a pretty good return on your funds for the past few years. But transitioning to lower interest rates, that brings gold back into the picture as opportunity cost reduces if you're investing in gold. And I think the last point there is a pretty critical one. So gold, when we talk about if it's $2,520 per ounce, that's priced in terms of US dollars. So it makes sense then that if the US dollar decreases in value, that would make gold easier to purchase for you or I, or anyone not purchasing in US dollars. If I'm purchasing in Australian dollars, then a weaker US dollar would help that. I'd get more, I'd be able to buy more gold for the same amount of Australian dollars. So I think that third one is key in terms of why that negative correlation exists between gold and the US dollar. Let's have a look at the historical relationship in terms of the chart. So I think we can see there gold being the golden coloured line, once again appropriately, and the US dollar essentially, the dollar index. So USD against a basket of currencies is the light blue one there. And I think we can see there that there's periods, say, between 2010, 2014, 15, there's a pretty clear negative correlation. Gold went up, the US dollar went down. And again, it's pretty clear to see there around 2020, 2022, once again, US dollar went lower, gold went higher. But there are some times where they both appreciate or depreciate at the same time. So there are some exceptions to that rule, which we'll look at. So what are some of the imperfections in the relationship? So depending on what period you're looking at, we could be talking about a negative correlation coefficient of maybe negative 0.8, 0.9. Other times it could be closer to 0. But there are times, like I've circled in this chart here, from April this year, where gold and the USD did go higher in unison. So that's what I would call an exception to the rule. It's not like the laws of physics. It won't hold every time, this negative correlation. But we can see there a period where they were both appreciating at the same time, albeit I would say that occurs in the minority of cases rather than the majority. Another one we can look at here, we can substitute US Treasury yields for the US dollar. Because if the US dollar, that's closely tied to what happens with US Treasury yields. So high yields in the US, that generally benefits the US dollar because people want to purchase USD to basically invest in bonds and treasuries. So once again, this is basically just reflecting what we saw on the previous chart, which is once again another exception to the rule. And we'll have a look at some of the reasons why they can both sometimes go up at the same time, albeit in the minority of cases. So why does the negative correlation sometimes break down? As I said, they can both be viewed as safe haven assets. So if the market gets spooked during certain times, then investors can rush to both buying USD as a safe haven and gold as a safe haven as well. And we've seen that at certain times. If we cast our minds back to last year, when there was that regional banking crisis around March, April last year, a lot of risk aversion. People were selling out of stocks and they were putting funds into gold and the US dollar. Hence, they both went up at the same time. And we saw a little bit of that earlier this year as well in that April period, where they both increased at the same time. So during that period in April, we saw US inflation figures moving higher. That helped the US dollar from a yield perspective, and it also helped gold in terms of being an inflation hedge. Now, we'll often hear this term that gold is used as a hedge against inflation. What does that mean? Well, a lot of currencies, for example, during high inflationary periods, or periods when there are a lot of quantitative easing, let's say, a lot of printing of money, in other words, currencies can devalue, gold won't. You can't devalue a bullion of gold, for example, but if you print more USD, that can reduce the purchasing power parity. So that's why gold is seen as an inflation hedge, and that ties into what we're just discussing, where we do get these periods occasionally where they both go up at the same time. And April this year, because there were inflationary concerns. So what is the outlook? What is the outlook for gold, the US dollar, and interest rates? So, because this is what's going to drive both gold and the USD going forward, in my view. I mean, markets are very sensitive to rates. We saw what happened in response to Jerome Powell's comments on US rates end of last week, FOMC meeting before that. We saw a move higher in risk assets. So, as I said, generally speaking, if we look at sort of where we are now, US rates at 5.5%, and a projection that the US will be cutting interest rates, perhaps starting next month, then that would bode well for gold from an opportunity cost point of view. So there is a fundamental case to be made that gold could be pushing higher, with some caveats, which we'll get into in a moment. And also it comes down to that yield differential of the USD. So as I talked about, US rates, they have been at 5.5% for some time now, which is higher than most other economies around the world, including here in Australia. So if you're chasing yield, as investors tend to do, then you're getting, say, 5.5% in the US versus 4.35% in Australia, or 4.5%, 5% in the UK or in Europe, for example. So you tend to follow the higher interest rates, those chasing yield, that benefits the USD. So in terms of the outlook, so we heard from Jerome Powell last week at Jackson Hole, a very scenic event there in Wyoming in the US, and he was signaling that the US will start cutting interest rates. Right now, current market pricing is that we'll probably see 100 basis points of cuts from the Federal Reserve between now and year end, and up to 200 basis points of cuts between now and the end of 2025. So there's a lot of dovishness currently priced into markets at the current time. And that's why we're seeing gold where it is at record highs. US dollar, not so long ago, it was around the dollar index, around 104, 105. Now it's just above the 100 level. So a lot of dovishness is already priced into the markets. That's something to take into account in terms of market expectations for interest rates going forward. Because a lot of the market got it wrong heading into this year. There was quite a dovish picture for markets. If we go back to December last year, January, markets were expecting the Fed start cutting rates around March, April. Didn't happen. And now we're only just getting to that stage. So that's why I just add a word of caution that yes, markets are dovish on what we expect from the Federal Reserve, but markets can be wrong. It's very data dependent, to quote the Fed chairman himself there. So gold, so we had a target on it of $2,500 from about February this year. That was what we were looking at. And now it's got to that level. So I'm expecting a period of consolidation in gold. I think there is the prospect for it to go higher. I wouldn't be surprised if we do see gold moving to $2,600, $2,700 at some point. But that is predicated on the dovishness from the Federal Reserve staying in place, for example. So if the Fed goes ahead and, they cut 200 basis points and US interest rates move from 5.5% to 3.5%, then there's a case to be made for gold moving higher. But if the market gets it wrong, if inflation proves to be non-linear, as it has done in the past, and starts to tick a little bit higher, we could see market expectations change. Maybe it won't be 200 basis points of cuts we see from the Fed. Maybe it's 100 or 150. That would probably help the US dollar, maybe put the brakes on the gold price moving forward. So I guess that's where we're at the moment in terms of the gold market and the USD. So it's a golden period for gold, and I think the picture still looks bright, but with those caveats that the Fed needs to deliver the goods with interest rate cuts. Macro data from the US can be a little bit patchy. Right now inflation is pretty much close to their target level, and now to come down to what size of rate cut we could see next month. So September, a big meeting for the Federal Reserve. Markets are currently tossing up whether we'll see 25 or 50 basis points of cuts. I'm leaning towards 25, but it depends what happens with the non-farm payrolls figures next week. I think if we see another disappointing figure there, 50 basis points will come back into the equation perhaps. So I think that's where gold and the USD and interest rates are all tied in together. And that's why we are seeing gold at these record highs right now. I've just put another one in there to look at in terms of a longer term view, which is BRICS. So BRICS, they do want to move away from the USD and have a de-dollarization to create some separation, less dependence on the USD, and maybe introduce their own currency. And if they do, that would probably be a gold-backed currency. And I think that's why China, Russia, and the likes are basically stockpiling gold at the moment. That's more of perhaps a decade-long process in my view, rather than over a 12-month horizon, for example. But that would be a double whammy for the gold price if they move ahead with that, because they'd be selling USD and moving into gold and therefore buying gold. And that's where we could see the USD lose its mantle as the reserve currency. But as I said, that's sort of a decades-long process we're looking at there. So I think that's pretty much where we're at the moment. So as I said, this is very interesting to watch at the moment. I wouldn't be surprised if we do see gold ticking higher, but keep an eye on that interest rate outlook. If that 200 basis points of cuts between now and next year holds, I'd expect we could see gold heading higher from here. Any stronger data from the US in the meantime could see a bit of a setback and maybe a rebound in the USD. So it's pretty much all tied in together. So that's pretty much my take on the gold market, and I hope you've found some value out of it. And any questions, feel free to come and see me or any of the team from KCM Trade. And thank you very much for your time, and I hope you enjoy the rest of the event. Thank you.